What is the history behind universal life and index universal life? How did it come about? By the end of this video episode, you will understand why a properly structured, maximum funded indexed universal life insurance contract allows you in the Internal Revenue Code to accumulate your money tax-free. You can access your money tax-free, including all the gain. And when you ultimately pass away, anything left in there blossoms, increases in value, and transfers totally income tax-free. So as we proceed, you're going to be blown away with what I'm going to teach you a bit about the history of one of my favorite financial vehicles. So in other episodes, I give my story. I began in 1974, and I was helping a lot of people buy term and invest the difference. And I began to realize a lot of people, when their money was in the market, they could be subject to downturns or recessions or market crashes. And so between 1974 and 1980, I ended up with over 3,000 clients in 13 Western states that I was responsible for. And in 1980, that's when Universal Life was first introduced by E.F. Hutton, and they weren't an insurance company, they were a brokerage firm. And my clients were never happier than when I got them out of the market. But let's talk about why E.F. Hutton even came up with this idea, because they realized that even if they could earn their clients 12% rates of return, they weren't netting 12. If you put your money in the market in a diversified portfolio of mutual funds, and if you could earn 12%, which most people do not earn because they buy and sell at the wrong times, but let's say you could, it means that if, when you finally retire, if you had $1 million nest egg, let's use that, and you can extrapolate from the million no matter how much you have, if you have less than that or 10 times that. If you had $1 million nest egg earning 12%, you could pull out $120,000 without depleting your principal. But that's not all your money. Between federal and state income tax, most Americans pay about a third in taxes. So you pull out $120,000 and you're paying $40,000 in taxes, and you're only netting $80,000. But no, they charge you 1% to manage that million. So you deduct the fees and you're only netting $70,000. So you had to earn 12 to net 7. But see, most Americans at best were only earning 9, and they were netting only 5. Well, unfortunately, a lot of people buy and sell at the wrong times in the market. And according to Dalbar, most Americans are only averaging about 3.5%. So that's really pathetic. And the financial services industry came up with this 4% rule. They only want you to pull out 4% because they don't want to be sued for you outliving your money. That means $1 million nest egg would only generate $40,000. And then you have to pay tax. Even in the 25% bracket, you're only netting 30. After fees, you're only netting 20 or 2%. So in 1980, this is what E.F. Hutton realized. We can do better. And so they realized in the Internal Revenue Code, there's 3 sections that have sort of protected insurance policies from income tax. Why? Because when you insure yourself and you use life insurance to protect yourself if you die, you're trying to be responsible and accountable so that your widow, your orphans, they will not rely on government welfare. And so the government says, yeah, let's allow them to accumulate the money tax-free, because why would we tax people on something they're trying to be, independent? And so they have never taxed it for over 108 years. So in one form or another in the Internal Revenue Code, currently, money inside of a life insurance policy grows tax-free under Section 72E, all the interest, dividends, and so forth. And when you access money while you're still alive, you don't have to pay tax on any of the gain if you do it the smart way under Section 7702. And then when you ultimately die, anything left in there blossoms and transfers income tax-free. Now, when I say blossom, some people go, what are you talking about? See, I'm just about 70 years old as of the recording of this episode. If I died in an accident tomorrow, every million that I might have in my portfolio, let's say of IULs, would blossom to about 2.5 million if I died. And people say, what? Yeah, there's not a Roth IRA or 401k that will 2.5 times itself when you die. People say, well, golly, how much does that cost? And I go, well, nothing's free, but it doesn't cost me anything. It's being paid for with a minuscule portion of interest that would otherwise go out the window in unnecessary tax. And so, it's nothing else does this, because under Section 101A, if I die with $1 million in my IULs, I'll leave behind, more than $2 million tax-free to my spouse and my kids. So E.F. Hutton realized that back in 1980. And so that's when they came up with this idea. Well, let's take the least amount of insurance the IRS will let us get away with under these sections of the code, and let's put in the most premium, the most money the IRS allows, as fast as they allow, and this turns this into a tax-free cash cow. Okay, so that's what happened in 1980, and there was this massive exodus of money leaving the banks and the brokerage firms into these vehicles because they were tax-free. They paid higher interest in those institutions, and when you died, they blossomed and transferred tax-free, and so forth. And they couldn't compete. Well, the IRS went to Hutton and said, "What are you doing?" And they said, "We're not doing anything wrong. We're adhering to these sections of the code." And the IRS said, "We think you're abusing it." And they went to court, and E.F. Hutton won. They weren't doing anything wrong, because the IRS was going, "Well, who buys this much life insurance and puts this much money into it?" Well, our clients do, because they're using it for living benefits. So they decided they needed to redefine tax-free under this section of the code, because if you violated it or overstepped the bounds, it would move from these sections of the code over to a different part of the code, taxable interest. It would be deemed an investment. No, we don't want it to be called an investment, because investments are taxed sooner or later, and they're usually subject to market volatility. So you have to stay under these three sections of the code. So E.F. Hutton did that, and then the IRS went to Congress and said, we've got to change the definition of tax-free. So in 1982, under the Tax Equity Fiscal Responsibility Act of 1982, they tried to dictate the minimum amount of insurance that had to be put on the insured in order for it to stay tax-free under these three sections of the code. They didn't even understand what they were doing, and does that surprise you? And so 2 years later, they had to redefine it under the Deficit Reduction Act. These two are acronyms, okay? They're called TEFRA and DEFRA. In a nutshell, the TEFRA-DEFRA tax citations dictate the minimum amount of insurance that you have to have on the insured if you're going to use it for living death benefits based upon your age, gender, and health. Now, what I just said, you wouldn't believe how many insurance agents don't even understand. See, remember, Hutton came up with the idea, let's take the least amount of insurance that the IRS will let us get away with. That's under TEFRA and DEFRA. Let's put in the most money the IRS allows. Okay, that's under these, as fast as they allow, and that's under TAMRA, which I'll explain in just a moment. Now, the IRS, Congress gave it parity. That means equality, which basically means if you're going to use an IUL insurance policy primarily for living benefits, so that you can have equality, it doesn't matter if you're a 22-year-old athletic marathon running female, or if you're a 60-year-old male, or if you're an 80-year-old male with 3 blocked arteries, adult onset diabetes, prostate cancer episodes, which I have a client that had all of those issues. The cost of the insurance can be the same for all of those 3 people, because the amount of insurance that the IRS requires under TEFRA and DEFRA is less every month older you are. So that the 80-year-old, if they earned 11, they would net 10, just like a 20-year-old. It's just the 20-year-old has to have more insurance than the 80-year-old, or said another way, the 60-year-old gets away with having to have less insurance under TEFRA and DEFRA than the 22-year-old, and the 80-year-old gets away with even less insurance than the 60-year-old. You also get to self-insure. So this gave it parity. And I had clients that were earning 11 and netting 10, and it was incredible. They would put in $500,000 and start pulling out $50,000 a year tax-free without depleting principal. There was this massive exodus of money leaving the banks, the brokerage firms from 1980 82, 84, all the way to 1988. And then the banks and brokerage firms said, we can't compete. We've got to level the playing field. Now, they didn't want to kill these because this is where they put some of their money. In fact, 30 to 40% of their tier one assets is invested in the insurance companies, usually in the form of BOLI, bank-owned life insurance, okay? So they didn't want to kill it. They just wanted to slow the flow. So in 1988, June 21st, under the Technical and Miscellaneous Revenue Act, they said, well, if you put in a whole lump sum of money, let's say $500,000, there's nothing magic about that number, but let's just use it to be consistent. If you put in 500,000, you can no longer immediately start pulling out 50,000 a year tax-free based upon a 10% payout. If you start taking out the money, it's going to be taxable LIFO, last in, first out, like an annuity or most investments. If you want it to be tax-free, it will accumulate tax-free, but if you want tax-free income, you've got to spread it out over 4 or 5 payments. So under TAMRA, we have to figure out how much can we put in so that when we access the money, it's tax-free. TEFRA and DEFRA has to do with the death benefit. What's the amount of death benefit? TAMRA has to do with when you access money under Section 7702. So far, so good. So let's go to this bucket analogy. Let's say a bucket is an IUL policy. This is the repository where you want to be able to put in X amount of money. So let's say the amount of money that you want to put in is $500,000 over the next 5 years, 10 years, 20 years, or whatever. You used to be able to put it in one fell swoop. Now, you can still do that, but that's called a modified endowment contract. It'll accumulate tax deferred. But when you start taking money out, it's now taxable. Most people came to me because they wanted tax-free income. So if you put in $500,000 and let's say you're 60, the minimum death benefit under TEFRA and DEFRA was $1,250,000, about 2.5 times that. Again, you could buy way more life insurance than $1,250,000 for $500,000, but that's not the objective. You want the least amount of insurance the IRS will let you get away with. And so it's approximately 2.5 times that if you're a 60-year-old male, okay? Now, if you're younger, you need more insurance. If you're older, you need less insurance. And as you put the money in, it qualifies as part of that. So as you get older, this actually gets cheaper because the amount of insurance that's at risk to the insurance company is less. They only charge you for the difference. If you've got $500,000 in there, they're only at risk for the remaining $750,000. This will likely double in 7.5 to 10 years. When this has grown to $1 million, the remaining amount is only $250,000. A lot of agents don't understand this concept. It gets cheaper as you get older when you structure it correctly. But let's go back to the TEFRA DEFRA. People used to be able to put in the whole $500,000 and start immediately taking out income. When TAMRA was passed, they said, oh, no, you can only put in about 20% a year would be the maximum. So in this case, this would be about $100,000. $100,000 the first year, second year, third year, fourth year, fifth year, okay? And if you did it that way, then when you access money forever after, it's totally income tax free. Pretty phenomenal, okay? So a lot of times we compare this to like a building that I'm going to show you here in just a moment. But if you want to have one of these done correctly, you've got to find an IUL specialist or professional that understands how to calculate the guideline single premium, which is the amount of money that you want to put in during the first 11 years, basically, or you can put it in 5 years. The guideline level or guideline annual premium is the amount that you can put in on an annual basis for the rest of your life if you wanted to just sock away money every year for the next 20 or 30 years. TAMRA, I've just explained. You can put only that much into the policy, but with whole life, it's a 7-year period. With universal life, you can get the money in 5 years or even less, okay? You have options. The level death benefit option, option A, is where your cash qualifies as part of the death benefit, so the insurance can get cheaper as you get older. If you use the increasing death benefit, you only want to use that while maybe you're putting money in. The minute you stop putting money in, you want to switch to this one if you want the cost of insurance to get cheaper, okay? So you have to meet with an IUL professional that understands these concepts. And that's why I encourage people, hey, make sure, because the biggest reason why these don't work is because the advisor was not proficient in understanding how to do this. So I mentioned this building. Let's say the IRS said, you know what, you can build a 5-story apartment building. And if you will only lease out or rent out the first floor the first year, and then the first day of the second year, we'll let you lease out the entire second floor of this building. I don't care if this is commercial or residential. And the third year, you can lease that out, the fourth year and the fifth year. In fact, the first day of the fifth year, which would be 4 years and 1 day, we'll let you fill up the rest of the building. And if you will wait to do it this way, all of your rental income from this forever after will be totally tax-free. Sounds silly, doesn't it? But I would do that to have tax-free income forever. This is what TAMRA dictated with life insurance. If you will only fund it no faster than 5 installments, all of the money you ever take out of this, all your profits forever will be totally tax-free. That is TAMRA. And so this is the beauty behind it. If this is resonating with you, I want you to be able to learn. So here's how. This is my 11th book. It's called The Laser Fund. It's co-authored with my 2 sons, Emron and Aaron. They're specialists in IUL. And I want to gift you a free copy of this. How can you claim yours? You simply go to Laser Fund, L-A-S-E-R, laserfund.com, or click on the link below. And you contribute a nominal amount towards the shipping and handling, and I'll cover the rest of that cost. I will pay for the book. I'll fire out you a free copy. This is 300 pages. And then there's options there to listen and learn and watch and learn. There's master classes and everything else. But this is about you and your brighter future. I'll pay for the book. It's actually 2 books in one. This side, the white side, is for the left brain learner. It has 14 chapters with all the charts and graphs and explanations. If you learn more by stories, right brain, you flip it over and read this one. This is 100 pages with 62 actual client stories of how the Laser Fund is the dream solution for a lot of financial goals, not just retirement. So this is about you and your brighter future. Claim your free copy and make sure you meet with an IUL professional that is a professional that knows how to do it correctly.